Alrighty, Doc here. TGIF. Thank God it's Friday. Another fun-filled week has passed us by. And how did they end the week? Well, Mr. and Mrs. Trump end up with a very mild level of the coronavirus. Remember, it's the White House, so they have a much more stringent measurement of the virus, and that means basically that he is showing signs of having the virus. So they automatically just go into defensive mode and treat it like he has the virus, which he does, of course, but it's not. I guess what's the word? It's not in an aggressive state yet because they caught it so early. I guess that's what it comes down to. We'll see. We have 13 days to watch this, and they're going to be testing over the next 24 and 48 hours and measuring and so forth, and it'll be very interesting to see how this whole thing plays out. It will be very nice to actually watch a live patient that has the virus and watch them actually live, and we'll follow through it all because there's a great debate about the virus and how many people have it and how many died from it. And when you look at the CDC tells you that. You know, they say it could be anywhere from 10,000 that died to 200,000 that died because the death certificates are not as accurate as they would hope. And since the first bill was passed to pay monies to any hospital that anybody died of coronavirus, everybody who was dying that even remotely was touched with the virus was being labeled as dying of the virus when they may have died from other complications that they were already sick with. So I saw where cancer patients were listed as dying with the coronavirus. So anything's possible. You got to laugh at that stuff. I mean, you can't make this stuff up when it comes to the U.S. media and what's going on. So anyway, it's going to be very interesting. We're all going to learn from it. What I'm going to finish this off, this little point of view, since this is the news of the day and the way that it ended the week, and that is that 99.5% of the people, that's almost 100% of the people who catch coronavirus survive the virus. Okay, so 99.5. So if it was 5/10 more, it would be 100% survive the virus. All right, from the ages of 70 and lower. Now, the first lady, I believe, is in her late or early 50s, possibly. I think it's something like that, or late 40s. And I think it's a 26-year difference. And Mr. Trump is 73, so it would be 50. She may be 46 or 47. I think it's something like that. So she has a 99 point. What is that? She has a 99. Anybody under 65 has something like a 99.7. So that's 99.7. 3 more tenths, it's 100% that they survive. So now, whereas Mr. Trump is 73 years old, he is playing with the 99.5 or a little less. I think there's a lower number above 70. It could be as low as 96%. So that's what we have, and we're going to all be able to experience it. We'll all be able to see it live. So that'll be very fascinating, just like, watching the markets live. So, all right, that finishes that up, and that was the first 4 minutes of our webinar there. So let's get rolling along. And notice lately we have started off with the Turkish lira, what is it? The Swiss franc. We've been watching the Swiss franc for weeks and raving about the Swiss franc and the ability of the national Swiss bank, their central bank, and how well they function. And we really are seeing some interesting characteristics that we really like looking at the Swiss franc dollar pairs trade. When the Swiss franc is moving down, obviously the dollar is moving down in value and the Swiss franc is becoming more valuable. And we find some of the other pairs trades not as consistently moving at that same speed. So in other words, they have to catch up to the Swiss, it seems like, after a day or two. So We're watching the Swiss franc now as the first, and then we go over to the euro unless someone asks for something, and then I stop cold. Doc likes to do that. He stops cold, and he goes and answers any question at any time, whenever, whatever, whoever. And so that's how we do it here. Now let me just check our chat line to see if anybody has stopped in to say hi. Why am I having problems with this mouse? Oh, there it is. There we go. We've got a visitor today already. Farkas is here. Hey, haven't seen you in a couple days. How are you doing? It's TGIF. I hope wherever you are, it's at least lunchtime and it's Party City already, or cocktail. The two martini lunch of Friday. How's that? Or if you're not into the alcohol, I hope you're just having a good cup of tea and just enjoying yourself because it is Friday and we're really happy about the idea that it's Friday. So, all right. So we're looking at the I want to say the Turkish lira over and over again. It's so fascinating watching the Turkish lira. Matter of fact, I got teased this morning. I must have had Euro Turkish lira up there, and I saw the 9 handle, and I thought it was the dollar Turkish lira, and I was like, oh my God! It jumped through the 8 and went right to the 9. I was like, oh my God! I felt so sad for the Turkish population, and obviously the president / former prime minister. This must be what he's aiming for. He wants a higher Turkish lira against the dollar because since he's gotten in control, being prime minister and then being president, the thing has gone from 1.5 to basically 8. So wow, I mean this is obviously some type of concept that he has about finance and so forth, and we'll see how that works out over time. But anyway, that's where we are there. So, and you can see it here on J4X, it's trying to do a little bottoming also. You got a lot of red going on in there, just like we have red right here going on. We've been in a daily sell for, 3 days, and it looks like it's playing with the buy at the moment, but we don't see any green dots. Let's just give this a refresh and see what it looks like. Yeah, no dot there now. So it is trying to get into the buy. Matter of fact, if we widen this out using our Chicago Quant, you can see here it's plus. It's actually trying to get through the daily buy. You can see we're in a weekly buy. So it looks like the dollar is actually firming up in there, huh? How about that? Is there any valuation method that allows me to enter the expected mini max prices, spot and strike value, and get as output the fair price for the option, American or European? Woo, an option question. I like that. Oh, talk dirty to me. Oh, yeah, baby. I love option questions. Oh, I'm excited now. All right, is there any valuation method? Okay, well, there are a few, and it all comes down to what you're trying to do. So there are two good ways of looking at valuing an option, all right, the premium of the option. And one is obviously looking at the bid and offer, and obviously right off when you're trying to buy it, bid just a little bit higher than the bid, but don't take the offer out, okay? That's to start off with. There's a few things we can discuss about that. So we're going to dissect this. Oh yeah, this is going to be like a fine wine. We're going to work this question over real well. I like that. So is there any valuation method? Well, to start off with, the market itself is a valuation method. So what happens is, let's say you're looking at a product. If you want to give us an example of a product, we can actually look at the options live, and I can show you. So forecast, if you want, throw up the product you're thinking about, and we can really take this apart even more thoroughly, I guess you could say there. Now, is it possible for Forex options? Sure. Now, Forex options, the old Philadelphia cash options or spot options are now traded at the Chicago Board of Trade. They bought them. They bought that exchange, the Philadelphia Currency Options Exchange, from the Philadelphia Stock Exchange. So it's out there somewhere. And then there's obviously the CME, the competitor, is offering futures options. And then obviously you have some brokers offering spot options. So the best way would be is to go look at their bid and offer to try to get a feel for the action by watching it flow during a transaction. So let me just show you that. Let's show you that live. Let's see, where can I put that? If I go there, I go there, and I go there, and let's see, let's find a product. Let's see, what do we got there? Let's find a product that we're trying to look at. Let me put my glasses on too at the same time. Alright, now let's see if we can find a product. Alright, let's do this. So, let's see, right there. There's GBP, but that's September. We've got to put something else in there. So let's try this. Let's try the euro, because the euro is probably like the most liquid of all the products, I think that's 6E. 6E Z O. Let's see if that does it. Yep, there we go. All right. All right, now we're going to switch you over to another screen. And this is going to be very interesting. This may scare some people, so please lower your volume when I'm talking about options, because I don't want you to get too scared about this whole thing. And a lot of people get scared when we discuss options. We've talked about the five words that really terrify people. I mean, just put sheer panic into them. There we go. And so let's see if we can do this. Right there. So the 5 words are call, which you see up there. It's right there. Put, that's the second word. Down the middle, you see strike price or strike. That's the third word that totally just flips people out. Fourth one is the premium, which is right here. They don't even put the word premium up there. They really try to hide information from you. This is how nefarious the options industry is. They try to steal money from you in every which way. And the bid and ask is the bid and ask of the premium right here. So when you see a bid and an ask on an option, it's the premium. And so they do their best to confuse the daylights out of you, because you're going like, what am I buying? Am I buying what is that? And then the last one is expiration, which is right, where is that at? It's on here, 7 days, right there in that top box. See right there where I'm flashing it? It says 7 days. It'll expire in 7 days. Every option chain and so forth will tell you, like, here's a 35-day one if we go like that. There's a 63-day one where it expires in 63 days. There's one that's 98 days and so forth. So now let's just go to the live. Let's see. Let's go to the live again, and the most active one, which is to be the front month here. Now we look at the product itself. Let's see if we can find it on here. They like to do that too. They like to hide stuff like that. Well, let's see if we can find the futures product. Where is it at? And I want to be able to, oh, there it is. I see it. Okay, so it's right there. 117.29. Let's put it up on, let's show you what the spot is doing. And that is the December contract of the futures. And let's see. Let's put the euro up there at the same time. You can see it's trading at 117.10. And you can see the futures contract is 117.27, showing you 17 pip carry for the next 2.5 months. And so that's the name of the game there. Someone just sent me something about fusion energy. we go. Just have to answer them back. It's one of my sons. All right. All right. Now, let's see. Middle-aged muscle. Hey, middle-aged muscle. How you doing? We're dissecting options here, but if you have a quick futures question, we'll show you that too. That's all. That's all trade is futures option. That's all you trade is futures and options for the last 25 years. Very rare that I'll do a futures contract. Smart. The only reason you ever need to do a futures contract is if you have an option spread on, and you get exercised, and so then you can, you can turn things into like a free position. A lot of times when you get exercised, it turns into a free opportunity. So yeah, and then there's a lot of option traders that play that game, where they try to get exercised, and then they get extra money out of it all, and then they're hedged. Let's see. One day I'll need to upgrade my fusion reactor to Casimir one. No. My son sent me something over on a fusion reactor, and I see South Korea has these little mini ones that are very safe. It's just been accepted by the United States. But no, I'm more into the Sapphire project. I'm part of the Electric Universe. And so all of you, I suggest to take a look at the Electric Universe and the Sapphire project. That's so much better, The sun is an electrical process, and it's not an atomic process. Okay, so there, I've answered him at the same time. I'm doing physics and options. All right, let's give. I'm going to give, and I want to give a bravo to muscle, muscle age, middle age muscle. Bravo on that. I'm right there with you with the options. Okay, now let's take a look at this. You can see here, the product is still sitting at 117.27. Now it's 28, but it's a really tight market there. 28.5, and so let's say you were there. Now let's go back to the question, and that is, it says, let's see, was it? Forecast says, is there any valuation method that allows me to enter the expected minimum and maximum prices? Well, to start off with, you look at the bid and offer. So let's look at the 117 calls, or let's say the one, they do them in quarters. So it's 117, 117.25, 117.50. You can see they're 31 bid at 34 pips. So 31 pips at 34. So if you were trying to buy the 17.5 put, the call, I would suggest bid 32 and see if they come down to a 33 offer. Okay, that's to start off with. And same thing with the puts. You can see the puts are 4 wide. Same put, 53 at 57. Now it's 53 at 56. And I would say bid 54 to start off with. Let it sit there for a few, like 30 seconds or a minute. And it depends on the strategy that you're using. If you're doing spreads, you can't see the window. Oh, shoot. Sorry about that. There we are. What is that? No, cancel. Cancel. Why won't that move? It's locked. Why are you locked? What is that? Let's see. Somehow or another, by showing. Okay, there it is. Okay, so there it is there. All right. So in this case here, there's the 117.50. Now it's 30 at 33 because obviously it is dropping. And where's it at now? It's trading at 117.26. So it's basically dropped 2 pips, and the options have moved from 30. What did I say to bid 33 or 32 or something like that? I think it was 31 at 34. So I said bid 32. Now it's 30 at 33. More than likely you would be filled. Now that's just a simple way of getting a better price. Is just start off, if you're buying, put it on the bid. If you're selling, put it on the offer. Now it comes down to what is the strategy that you're using. That's the second part, because when it comes to deciding on premium and price, there's a few methods out there. Obviously, if you're trading volatility and not trading the direction of the market, then what you want to do is let's see, what is this? Invent. I guess I just have to answer this. So anyway, that's the where was I at? I'm answering physics questions at the same time. He's getting really aggressive with me. What? Wait, in webinar, back after. Okay, so all right, so now let's. I got him off my back now. So that is one. All right, now let's go back to that train of thought that I had, and that is that if you're trading volatility and not trading the underlying product itself, there's a whole different way of pricing options. Okay, but when you're just trading direction with the product itself, then it's a whole different game. So in other words, if you're buying bull spreads, or if you're buying naked long puts or naked long calls, which I rarely do. Usually I'm more of a spreader. Or you're setting up back spreads. You know, you're putting something on for 3 or 4 weeks, and you're buying more puts than you're selling short in the spread. So in other words, imagine if you were in the case here, you're very bearish on the euro. Doc has just gone into a weekly sell, and now we're in a daily sell. Okay, and you want to try to ride this thing. You think it's got, let's say you're like Daniel or something like that. You see a pivot that's 2.5 handles away, and you're thinking, ooh, maybe Doc's gone into the weekly sell and the daily sell. Maybe it's going to go after that pivot 250 pips away. So you have 2 ways you can, there's more than 2 ways, but there's 2 main ways I do it. When I have an attitude like that, where I think it's going to go somewhere when I get that signal, and that is I buy a put spread. Okay, so that means you would be buying, say, the something like the 117 put here, where it's bid 32, offered at 34. You see that on the screen there, where I'm highlighting them, and then maybe you go and sell something. Oh, wait a minute, that's 7 days. Normally, I would go to something like 35 days. So again, we go back to say the 117 or 16.5 put with it trading at, where's it at now? It's trading at 117.19. Okay, so it's dropped. What has it done? It's dropped 9 pips since we started looking at this. All right, so you go and you're buying, say, the say the 17 or the 16.5 put. You can see them. They're 77 at 78. They were just a 78 bid a few seconds ago. And then what you do is you go and say you sell something 200 pips further away. Let's see, where's that at? So there's 178. You might sell something like, say, the 15 puts 150 pips away. That's 33. And so you're basically paying 40 some odd pips to make 110 pips. So it's a 3-to-1 ratio of a win. Okay? and the decaying option on the 15 helps out a little of the decay of the 117 or 116 and a half put. In this case here, it's the 116 and a half. So that would help out as it's decaying. There's 32 on the 15 itself, so that's 46, 45, something like that. Like I said, it's about 45 pips to make 105 pips. In other words, it's 16 and a half. You subtract 15, that's 150 pips. You paid 42 pips for it. That gives you a win of 108. Okay, if it goes down to that area. And so that's and in between there, if you buy like a 3 lot or a 5 lot or something greater, as it's making some money, you can sell some of it off and still ride it down more and more. All right, so that's one way of looking at the valuation method that allows me to enter expected minimum and maximum price. There's another one. Let's say you don't you want to be a little bit more aggressive, but you what you do is you go and buy, say, the where is it at? In this case here, you would sell the 117 put short. Basically, it's 98 at 101, and then you go and you buy something like the 16 put. You know, it's priced at 58 at 60, and you would buy 2 of those and sell one of the 17. You can do things like that. You can even do it a little bit more aggressively. A little bit higher in the money. They're called back spreads, and if the thing drops 400 pips, boy, do you really rake it in. You rake in a lot of money because you're long more puts than you're short, and after a while, those long puts go into the money like the ones you shorted, but you're only short a few of them. And then what happens is it becomes a 100 delta on the long puts, and you can really make a lot of money out of those sometimes. I mean, really a lot. My best trade has been a little under $67 million on a $30,000 investment. So, it can get nuts. That was at a very volatile point, and the markets collapsed way beyond anything I was even imagining. And the next thing you know, it's in the millions. So anything is possible, and your risk obviously was, in my case there, was $30,000. And if my math had turned, maybe I'd have lost 4,000 or 5,000 or something like that. Maybe I'd have broke even, made a little bit. In this case here, the market's collapsed, and the next thing I know, it's up, bunches of money. So the back spread can be basically what the back spread is. When you do something like that, you're really buying a straddle. That's what you're really buying, and it's a put straddle. Most people know straddles as you're buying a call, you're buying a put, and you're hoping the two of them, the total price is, the success is greater than the total price of the two. In this case here, you're selling in the money and buying out of the money, and you're buying more. So you're buying 2 to 1, you might be buying 2.5 to 1, things like that, and that opens the doorway for a great potential. And so forth, and you're risking premium, of course, because you're buying premium, but it does set up the doorway for very interesting potential there, especially if you get some collapses like we get every so often around here. You get stock market collapses and out of nowhere, and they don't just go like 300 or 400 points in a weekly sell on me. They go like 7,000-8,000 points, and it's like, whoa, they're giving you incredible amounts of money, and they turn into not just tens of thousands of a win. They turn into tens of million a win. It's really weird. So that's just that. That's the part of that concept. Now we're going to go finish off this. Let's go to the other part of that question. And that is, let's see. He says, so enter the expected minimum and max prices, spot and strike value, and get as output the fair price for the option, American or European. Now, European options have a problem, and we use them on volatility here in the States, which is a real problem. You can't exercise them until they expire. And so what happens, they get discounted. Let's say you've got 60 days or 40 days in an option. It's in a European style. And they don't deliver really anything until they get closer to the expiration. So they can discount the premium. Whereas if it's an American, there's a threat that it could be exercised, so they have to move the premium around with a legitimate delta. Whereas when a European option, they don't usually move it around with a legitimate delta. Let's put it that way, because they're playing like a bell curve, and the odds of it going into or out of money and so forth. So that's the difference between the American and the European style options themselves. So you really, if you're trading on a very, very, very short-term basis, like 5 or 6 days, you can do the European option with no problem. But if you're trading a European option with like 3 months in it, and you're long it, you're going to be a little unhappy at times, because the underlying product is going to go down, and you're long these puts in European options, and they're not moving as much as the American options do. And that's why they call them that, because the Amsterdam exchange started trading European options, and the American exchange, when they started trading in Chicago, they started trading American style options that could be exercised. And so that's why that's the divide of European, and we trade European options in the United States. Like I said, some of the more trickier products, they use European options because it's a lot easier to hedge. In other words, it's really hard to hedge. Matter of fact, there's probably more products that should be traded European style in the United States, because they're just really very hard to hedge. But I'm not really sure if they do that much, as much as I would like them to do. So I hope I answered all that. Now let me just go back a little bit. I want to accentuate the thought I had without my son giving me discussions about Fusion versus Sapphire Project and Electric Universe. Trading options for volatility means you're not really paying attention to the underlying product at all. Whereas most of the conversation here, we're trading options looking at the underlying product. And so when you're trading options and you're just aiming to use it as a way of being long or short the underlying product, you can do a lot more things with it in that way and not worry about the volatility as much, especially if you're doing it in spreads. Because if you're doing it in spreads and you're not nakedly buying the puts because you're bearish, or nakedly buying the calls when you're bullish, then what happens is that by buying one option and selling another option 1-to-1 in ratio, it reduces the risk of the volatility. Now, obviously, if the volatility is enormously high, I mean like enormously high, it's not as beneficial, but it's still beneficial on some level in a short 5 or 6 day duration. And normally, I would imagine if you don't get your gratification, in other words, let's say you're bearish corn, let's put corn up there, because middle-aged muscle asks about corn most of the time. And also, you've seen the example here. I hope, Farkesh, you saw that example. We were looking at the one, what was it? It was 7 days, and it was the 117, the 117.50 call right there. Now it's 28 at 31. It's dropped 8 pips. Now it's 7 pips, now 6 pips. And you can see, how it went down from 34 offer down to 31 offer and 30 offer. Now we're 29 at 31. Now it's 28 at 31. And so you want to watch that action, and you want to bid that way, but it depends again on the strategy. Now let's go to was it muscle, middle-aged muscle. Let's go to middle-aged muscle, and let's look at the let's put this up there. Let's go to File and Open, and let's take a look at corn, and use a good example of what's going on in corn. Where the hell are you, corn? Where'd you run off to? There you are. Okay, there it is. Now let's let me entertain you. Let me make you smile. There we are. Okay, so now here is that's March red wheat. Let's go over to corn right there. All right, now we put this on the chart lately because it's been really funny. We talked about it yesterday, and that made me put it on the chart. That it just won't go into a daily sell. It just stays in that, and it's been in this weekly buy here. Now, 34 days. Today is like 35 days, and so forth. Now, let's say you're in a weekly buy right here, and you've been in a daily buy. Doc gets into a daily sell and then jumps into a weekly buy again. Maybe what you do is you would buy the 40 calls and sell, say, something like the 65 calls or something like that. Let's see if we can get a look at what the prices look like there. And let's go to that. Let's see, what product is it there? Let's do that. And that is, let's see if we can find it right there. So we go like Z, N, no, not N, ZC. Let's see, what's the futures in this thing? ZC, Z, 0. Let's see if we can get that. No, they don't have options there, so we have to, there must be another contract that they're doing the options on in corn. It's probably, I haven't traded that, but I would think it's the day contract, so it would be like something like C. Oops. So I think it would be C, Z, 0. Let's see if that does it. There it is. I haven't traded options in the grains in, I don't know, maybe 2 years or something like that. Yeah, see, it's asking for a subscription because it's a board of trade thing. That's why I was hoping to get the Globex ZC, I'm sorry. So you can see here they have this. That doesn't even make the strike prices right. That's saying it's at 1708. What am I looking at? It's 1708 down 64. Okay. All right. So we can try another product. Let's do this. Let's minimize that, and let's see. Let's try opening up another option page. Right there, and we're going to try opening up another one of my accounts in one of my other, and we'll just see if we can get it off of that. So, is there any possibility that the clearinghouse crashes? Well, options are the equity options are guaranteed by the OCC, and the futures options are I'm not sure who clears the future options anymore. They could. I don't think they're the OCC, but they could be. The OCC is the biggest bank on the planet. No one knows about that. They don't realize that the OCC is the #1 bank. And at the same time, I guess the CFTC makes sure the margins are accurate. So if the brokerage house goes under, the options are still good because they're not guaranteed by the brokerage house. They're guaranteed by the exchange. So you really don't have to worry about that. Does that make sense to you? That's why, also, where Farkash says, counterparty risk makes me afraid of trading options. Let's see. That's why they were illegal to be listed until 1976. Because of the computerization success. They re-legalized them. They had been outlawed in the United States, options on an exchange, since 1839, I think it was. So for the first 50 years in America, after the Revolution, we had legalized options also. But then they outlawed them because people were not, the counterparty risk was not backing things up. People were creating exchanges and disappearing. And so that is what happened there. So that's a good question. It's just that it's outdated now. That's all. But it's a good question. Now, if a brokerage house is selling you options and they're guaranteeing them, then there's a little concern there. You really want an exchange-listed option for that reason. So you want an exchange-listed option and not a broker. Now, if you're intraday trading the options, it's not that bad. And most times it won't be bad and so forth. But you really do want an exchange-listed option. I mean, Merrill Lynch is gone, and there's a bunch of others that are gone. So I mean that is the gist of it all, really. Some of these brokerage houses never survived. So let me see now. I'm heading towards the corn contract, and let's see if we can get the November option chain here. There it is, right there. Okay. Now let's move that a little bit so my account is not popping out at the same time. There's that. Oh, that didn't do it. Did it do it? That doesn't want to do that. All right, let's see what we can do about making this a little bit higher. Doesn't want to do that. Is it appearing anywhere? Yeah, let's see. All right, so let's see if we can do it the other way then. Let's bring that down like that. There we are. There we go. Okay, so now let's move over to this. Does that do it? Or does that do it? There we go. Okay, so here's corn. And this is November corn. Obviously, we're really looking at December corn. So, you know, I mean, this has 58 days in it. So that's not too bad. It's trading options on it. And so, let's see. Let's look at the strike price. There's a strike price right there in the middle. See them right there? And you can see that's the calls are, let's look at, where's the product at? 75 now? Where is corn nowadays? We've got corn trading at 78. So let's look at the 80 calls. I mean, we've already been up in a daily buy for 35 days. Let's look at the puts at this point. Let's look at the 370 puts. All right, there's the 370 puts, and they are 3 bid at 4. Right now, the options are no good because the markets are the exchange is not really, they don't trade them well at night. So what you have to do is you have to wait for when the exchange opens up, and then you can trade the options better. So there it is there. And so you know, I would be looking at like this. I'm waiting for me to get into a daily sell, and right now you can see on the, let's go back to the regular, you know, the chart, and let's see where are we at there. There, that's on it right there. There's the chart, and you can see the product is still cleanly up. I mean, it's wow. You know, look at this spiking stuff going on, and each time it's backed off, it's been very shallow. You know, even that one there was relatively shallow. It barely dropped what? Was that 20 cents? So if we get into a sell, but we're in a weekly buy, and you're trading options, you can get away with buying the put spread and taking a shot at it. But if you're trading the futures or some type of spot, you can't. It's very tough because, you know, you might get instant gratification for a day or two. You may not take it off, and the next thing you know, you don't know what to do when it is plus again compared to where you did it. And so, you know, if you're going to try to step into a sell and I'm in a weekly buy at the same time in a product, you better be like Jack be nimble, Jack be quick. You want to be in and out of it. Whereas in the options, you don't have much of a risk. You already know what you paid for the options. If it's an option spread in particular, which is my norm, then obviously it's like, wow, you know, you're barely risking enormously less than if you were long the product or short the product. And so, you know, you can afford to wait it out a little bit. And so that's the name of the game there. Now, you can see this action here. If we, like I said, if we can get a couple red dots and you know, the product starts to move down, then you know, you could try to play the put side of it on the options and see if you can get that a move back down into the 60 or something like that. But you can see some of these have been very shallow, and this thing just refuses to go into a daily sell. This thing has been tenacious, just tenacious, incredibly tenacious. So you know, it's well worth looking at and thinking about in that fashion there. I guess we're going to call this webinar Options 101 or Option Spread 101. How about that? Option Spread 101. How to trade options. I think that's what we're going to call this particular webinar. So that is that's the. I hope I've answered all your questions there. And if not, don't be afraid to ask another one. I'll go right back at it again. You know, I have no problem going further into this conversation. I just don't want to bore anybody. So you know, I'm here, and we can go look at other products. And if you want to look at I'm not going to close these options here at all. I'm just going to, what I'm going to do is I'm just going to switch. No, we already got it. We're going to switch to a different screen. That's all, like that. I mean, we're just going to stay on this, but the options are still there. If you want to ask me questions about options, we will go back to the option chain jack quick. Okay? And for muscle memory, or I want to say muscle memory, middle-aged muscle, you know, bravo. Keep on trading those options, buddy. 25 years, you're a veteran. God bless you. You could probably give us some real interesting input. That's what my algorithm was designed for in the beginning, to adjust my gamma. When I first invented the formula, it was to prove that the Higgs boson is a joke. In other words, it's just mathematical extrapolation. And so then from there, they legalized options, and I applied to the American Exchange and then the Philadelphia Exchange, and the options exchanges in 78, 79, and then I thought about it in 78. In 77, I thought about it too, but then 79, I definitely came back from England with my formula, and I was like, okay, I satisfied my physics side. Now I'm going to satisfy my money side. Let's look at spot Turkish lira. Let's do that. I love Turkish lira looking at it. It catches my eye all the time. Right there. So let's put it up on here. There it is right there on my Chicago Quant. And then let's put it right here. Right there. There we are. 1775. So it's moving down a little bit more still. You can see it here. It's trying to go into the daily sell. It hasn't been the best of the daily buys to begin with. I mean, it went into the buy here on a close of 777, 7.7756, and it ran all the way up as high as 7.8546. So what is that, like 17 pips? I don't know. Is that a couple handles? That might be a couple handles. So it was a pretty good move. And then the next day it was up there again, and then it rolled over, made a higher high than the close, but not a higher high of the day. And then yesterday it sold down hard, but didn't go into a sell here, and we're still green dotted. And let's just clean that up a little bit. So reload that. And you can see here today it's trying to climb up, but at the same time we've got the white line and the black histogram trying to play the minus. But look at the time manifold and the white line above the time manifold. And so right now it's not really pushing on it too hard. And you can see over on the spreadsheet, 4 days in a daily buy there. So there's the Turkish lira. Too bad they don't have options that we could use. Oh my God, I've been wanting options in that for so long, but the premiums are through the roof. I mean, you'd have to do trapezoids in that thing. Does anybody know what a trapezoid is? Like the mathematical configuration of a trapezoid. Or you'd have to fight to play butterflies. And when volatility is low, you can buy a butterfly, and then you go sell a butterfly when it's high, and you make money. Or vice versa. Sell the butterfly when the volatility is super high, hoping to buy back the butterfly cheaper if you're trading just volatility. So that's how those things work out. So high volatility, you're buying the butterfly, and then when it drops, you're able to sell the butterfly for more money. That's what it comes down to. So high volatility, you buy a butterfly. That's what it is. And then you sell it out when volatility drops. And that's how you trade volatility only, and you're not trading the underlying product. And a trapezoid is the same thing, except for instead of a butterfly, everybody knows the butterfly of buying one, selling two in the middle, and then buying one above. So in the case of, say, corn, you would be buying, say, the 370 call, selling the 380 or 390 call 2 times, and then buying this equal distance again. So in other words, let's say you bought the 370, sold the 385, and then you'd look 15 cents higher, and that would be the 400. You would buy that. So you buy the 70, buy the 400 one time each, and sell the 385 twice. Okay, now that's kind of more of an expiration play, and when you can put them on for even money or credit, then obviously it's a win-win instantly, and vice versa. So, but a trapezoid is somewhat of the same characteristic, except for now, imagine if you're doing a trapezoid in the corn. So in this case here, you would buy the 370, sell the 380, sell the 390, and then buy the 400. And that's the trapezoid. And then we've discussed the back spread. If you're playing the downside of a back spread, what you're really doing is you're trading a straddle. And so what happens is if you're using the coin again as an example, what we would do, let's say you become bearish, you would sell, say, the 380 put short, buy the 370 put, and you would do it to a 2-to-1 ratio or a 2.5-to-1 ratio or something like that, depending on how aggressive you want to be. So in other words, you would buy 5 370 puts and sell two 380 puts in the money, that type of thing. And that would be a put straddle that you're long. I know it sounds funny that you're long it when you're short in the money puts, but you're long that straddle. And you don't have an upside. Well, you do if you can do it for a credit. Then you have, in essence, you will, if you do it for a credit and it takes off. Let's say when corn was at 340, you sold the 350 put, 5 times, and you bought the 370 puts 8 times, say. So you sold them 5 times and you bought 8 of them, and you did it for a credit to yourself. Okay, so in other words, when you put that position on, it automatically was a credit, and you were paid like $3 or $4 to do it. Okay, and then all of a sudden Doc is still in a weekly buy, and you're thinking like, I'm gonna stop second guessing Doc's math, and the next thing you know, after a couple of weeks, the product is now trading at 380. So what happens is that the 350 puts have really lost a lot of money, and the 370 puts have lost a lot of money, and a lot of times that premium shrinks, and now you had it on for a credit, and you can take it off for less than what you bought the spread for in a credit. That's a little tangled in conversation, but in other words, you took in money when you put that spread on, and you were getting long it at the same time. And so that's how that works there. If anybody wants me to re-explain that again, I will explain that again. But you do have me rambling now about different strategies, and the old option trader is coming out of me, and I'm not really thinking that I have a lot of new people here. But you can watch the video and listen, and if you want to ask any questions, ask them. Don't be afraid. Doc trading options is like water. I've been doing it for so long. There's all kinds of wonderful strategies in this, demented little mind of mine. So the singing trader, the cowboy singing trader, just has a lot of strategies in his head that I can talk about and tell you about. So, all right, where are we at? We just took a look at the Turkish lira, and somehow or another, now my mind is in such an option mode that I drifted into an option strategy after looking at the Turkish lira. All right, let's go over to where? We did look at euro, right? I think we did. So let's look at cable. Excuse me. And I hope I didn't ramble too much about options there. I hope I was explaining them. Did I make any sense at all to anybody? I mean, obviously, middle-aged muscle, obviously I probably made a lot of sense to, since he's been trading them for 25 years. Things had to sound somewhat logical no matter what. No matter what style he uses to trade. But for those that just are newbies into the option universe, I may have gotten a little too exotic in the depth of it, but I was hoping that I made some sense. Did I make any sense? Please tell me I made some sense. If not, that's okay. You don't have to tell me that I did. If I was too complicated, that's okay too. You can say that, because this way I know how to try to dumb down my thought next time we get into a conversation. I just want to know if I'm catching the buttons right. All right, here's the cable. You can see the cable is acting much more firm than the euro, whereas the euro, let's just take a look at it. You can see here, this thing is barely curving, whereas let's take a look at the euro. There's a euro. I think it's rolling over, right? Yeah, look at that. It's trying to roll over here. It's curving too. And let's just take a look at the euro. So that's lower. You can see that thing is moving lower. The Hinky actually kind of hide that stuff. It's trying to tell you that it's up firm and high still, but it's not, because it's a lagging indicator. But it does emulate my dots. Whereas you can see here, I have no dot at the moment. Matter of fact, if we refresh that, let's see if we have a red dot developing. No red dot, but there is no dot, and it is below the sell number at the moment. And if it closes like this tonight, we are going to be putting a little red line right there. So, all right, let's see, what else can I say about any of these? And so the cable's acting pretty well in there. Cable's not really giving up the ghost at all. It's actually higher than the close of yesterday, and this is staying in a daily buy. Now the only problem with this is that you can see on the time manifold, the plus side in the nonlinear time manifold, and the white line is way buried low. So we're hoping to see that try to let's see, where's that? That is the cable, right? Yeah, let's put the cable up there. There we are. So you can see the quotes there. So we are hoping that they keep on rolling. I keep on thinking that matter of fact, that's that. How I was saying that the coronavirus could be a with the president getting the coronavirus, that could be literally a tip off. It could be really a tip off of actually a live experiment, seeing a person with the virus live and following them. I mean, the president of the United States is followed very closely, loved or hated, doesn't really matter. They still follow him. So it'll be interesting. What if the coronavirus is totally gone in like 12 days? I mean, will that tell people that, oh, maybe some of the stories we're hearing is not necessarily as accurate as we think? Or, wow, the guy had the virus, he's 73 years old, and he didn't die. Oh, maybe you don't instantly die just because you catch the virus. What was it? Joe Biden said something that was really weird. He said that there were like 6,200 military people that died to the coronavirus. And someone came out with the facts, and the Pentagon said there's only 7 people who died in the military with the coronavirus. So you have the presidential candidate telling you an incredibly false story, and the Pentagon comes out and says there's only 7 people who have died in uniform of the coronavirus, and the presidential candidate is saying that there's over 6,000 have died. So in uniform. So this is going to be a real learning experience watching the president go through this whole process. This is going to be very interesting. Because like I said, what happens if in 12 days or 11 days they declare that he doesn't have the virus anymore? It'll be like, oh, why am I so paranoid about the virus? Obviously or let's say he dies in 14 days. I mean, it's one or the other, obviously, isn't it? It's going to be very interesting no matter how you measure it. So that's where we're at. All right. Anyway, this is Doc from North America, and we're going to label this particular webinar as we're going to call it how to trade options. What? How to trade options? What are options? I don't know. What should we call this? Options 101? How about option spreads? Options and option spreads. How's that? That sounds pretty cool too, doesn't it? I don't know. Anybody have a particular opinion about it? Anyway, this is the Singing Cowboy. Options and spreads. We're just going to try that. This is a Singing Cowboy. Everybody have a safe and smart weekend, and we will catch you on Monday. So this is Doc from North America saying happy trails to you until we meet again. Happy trails to you, to all my option trading friends. Yippee-yi.